All right. Hello, everyone. So welcome to the 9th CoinGecko virtual meetup. I'm TM Lee, co-founder at CoinGecko, and I'll be moderating this panel session. The topic for today is about all things crypto in 2021. As you can tell, it is a really, really broad topic, and we're going to try to cover as much as possible on what lies ahead for the year. Joining us today are three great panelists. So we have Alex Svanevik, the co-founder and CEO at Nansen. And Nansen is an analytics platform for blockchain, which allows users to derive some insights and spot on-chain trends on the Ethereum ecosystem. Moving on next, we got Cheong, who is the founder at DeFiance Capital, one of the largest and earliest decentralized finance focused fund that is based in Asia. Lastly, we have Larry Cermak, the director of research at The Block. The Block is one of the leading research, analysis, and news brand in the blockchain space, producing a lot of awesome stories and content in the space. Welcome, everyone.
Thank you very much.
Hey, glad to be here.
All right, so we're going to start off with 2021 a little bit, right? So 2021 kind of start off with a very high note. You know, Bitcoin topped the new all-time high at $42,000. Ethereum closing in towards the last all-time high at 1,400. And we also start to see a lot of extreme volatility with altcoins going up and down double digits every day. You also get sentiments of people saying that, you know, this time is really, really different than 2017 bull run. But I guess the question here is that, is it really different though? Like, are we looking at a sustainable bull market in 2021, or are we in for a massive correction after such rapid run up?
So I think that the bull run is in some ways similar, but in some way different as well. I think that everyone will agree that there's definitely a lot more institutional adoption this time around. Like you can see that you can see from the numbers as well. Like the ItBit as a crypto exchange is one of the most regulated exchange. It was tied to Paxos. They were doing less than 5 million volume a day before the partnership with PayPal happened. But right now they're consistently doing, I think, 50 to 100 million or even slightly more over the last few weeks in volume. And most of the flow come from PayPal. So I think that this is a very clear sign of the volume increase from the, like, I would consider PayPal the institutional adoption, although the end user are not. And also that you see the bigger company like Ruffer and Mass Mutual buying. And we actually know a lot more they are buying underground. They don't want to make it public. They are also like $1 billion organization that's buying in the background as well. So I think this is something that's definitely different. And I think that one thing similar is I think the retail is also coming back. I think that especially the Block, the latest data dashboard provide a very useful guide on like the retail participation, the Twitter follower, the YouTube search, and all this thing of the, you can see that retail is starting to come back. I think I can even see from my follower growth as well. It has also increased quite a lot in the last 2 weeks as well. So I think that it's definitely championed by the institution first. I think that the rally from 20K to 30K, as in even to 35, was mostly institutional led because we can see a consistent, like a TWAP line of bidding on Coinbase. But I think when it hit 35 to 40,000, it seems to be more derivative led at that point. So I think that the institution, they were the main buying force between, I think probably from 15 to 30. But after that, it's a mix of both retail and also institution.
Yeah, there's a lot, I think as Arthur mentioned, mix of retail coming in after the institution coming in. But maybe we'll move on to Larry. Like, do you see that in your recent research pieces? I know you look at a macro view. What's your take on this?
Yeah, absolutely. I think I agree with almost everything that Arthur said. The rally was definitely started by a different catalyst than the last one. The last one, I think, was driven by ICOs, a lot of greed, a lot of retail people. And that's why, you know, it went up quickly and then it crashed really quickly as well. This rally is really different because, like Arthur said, it was mostly driven by institutional guys and institutional adoption. You know, and another data point that I can provide for that is if you look at LMAX, digital volume, you know, basically only institutional exchange volumes have gone up significantly compared to last year. So that's one thing. Another one, if you look at the volumes and open interest of the Bitcoin futures, another clear indicator that there's massive institutional adoption. And then, like Arthur said, a lot of like really different buying coming from Coinbase. So institutional capital definitely started it, but I agree with Arthur. Retail always comes. This is not going to be just institutional because when retail smells the opportunity, usually really late, they start jumping in. And I think we're fairly early to that. Like Arthur said, we track some of these indicators like, YouTube views, new Twitter followers, Wikipedia views, Google searches. You can find all the on the Black dashboard, but basically all of them are starting to pop out a little bit. I would say maybe like 20 to 30% there compared to what it was in 2017, but it's definitely increasing and it will continue to increase. Now the question is, how will this actually affect the market? I don't think that if retail, all of a sudden stops getting interested, I don't think we see such a dramatic crash like we saw before, mainly because there's capital that keeps coming in. I don't talk to that many institutional customers, but I do talk to a lot of them. And I think Arthur probably does as well, maybe Alex as well. And there's a lot more capital on the sidelines that's waiting to come in. And I think that's going to keep coming in, and that can potentially prevent like some of these like large crashes that we've seen before. So I'm optimistic. I think retail is starting to come in, but it's still an institutional rally.
On Alex side, right? You run Nansen, and I'm sure you also get to see certain kind of data point. I think Arthur and Larry mentioned mostly on the Bitcoin side because I think that's what institutions are mainly interested in. But I think on your side, you're running a Ethereum focused analytics platform, and I'm sure that also gives you some sort of indicator as well on maybe this rally is a bit different than the past. Maybe you can share in the data point of view if you would like to.
So I think there's two factors that makes this bull run different from 2017. I agree with both Arthur and Larry on the sort of macro environment being very powerful, driving a very powerful narrative for Bitcoin. The narrative around Bitcoin as an inflation hedge has probably never been more relevant. When you look at M1 supply doubling since the last all-time high for Bitcoin, or M2 going up 50%. So whatever metric you look at, there's a strong narrative there, no doubt, on Bitcoin and the macro environment. But as you said, there's another component which is DeFi. And so I think DeFi has been a massive catalyst for Ethereum in particular. And of course, there are other L1s that are looking to get a piece of the action on the DeFi narrative as well. But you can clearly see actually useful financial products on Ethereum. And I think that's very different from 2017, where it was mostly speculating on white papers. 2020 and 2021, you have actually useful financial products. Are so useful that they've actually maxed out the bandwidth of Ethereum to some extent, driving the need for Ethereum 2.0 and layer 2 solutions and so on. You could look at lots of metrics with regards to DeFi on Ethereum. Probably gas usage and the gas price is the main one that people are painfully aware of. I think another interesting one to look at, just in terms of the retail adoption that the other guys were, for deposit wallet activity on exchanges. And so at Nansen, we track basically accounts on different centralized exchanges, and you can see how many of those were active each month. And so if you look at Binance, a year ago, the difference is basically 3x. So we're up 3x, with regards to last year, just on how many active deposit wallets there are. And they map pretty well to user accounts in the case of Binance, but it's still, maybe 40, 50% of what it was back in, December 2017. So there's still a long way to go, I think, if we're aiming to hit the 2017 levels or higher.
One thing I'll add to that as well is that the volumes are at all-time highs, and in 2017 maybe they were like 60 to 70% of what they are now, and that's just another indicator of how much actual institutional capital is trading this, because the volumes are really, really high, and the same thing can be said for futures as well. Before it was mainly spot driven, and now we have 4 or 5 different futures platforms that are competing against each other. So even though there are definitely more retail users coming in, so much of that capital is institutional, and there's so much evidence of that.
So this makes a good segue to Ethereum, right? So I think as Alex mentioned, like there's a lot of action that's happened in the last 2 years ever since the ICO boom. Infrastructure and utility that's being built on top of Ethereum. You got killer apps like DeFi, DEXs, smart wallet, NFTs, and they all contribute to high gas fee. So like back in 2017, like Ethereum is mainly used, Ether itself as a currency is mainly used to get into ICOs and stuff like that. And that probably drives up the demand towards the $1,400 high. And then this time around it's a little bit different in the sense that it's being used probably to pay for gas, right? Mainly. Is that the reason why we are not seeing an all-time high in Ethereum yet? I mean, we're inching closely, but it's not a strong like kind of like Bitcoin where it just crosses through the all-time high and just goes straight up. I mean, price action aside, in general, where is Ethereum headed? Like we can talk about the scalability problem, Ethereum 2.0, the layer 2. I think in general, like where is Ethereum going in 2021? Because it sounds like the start of the year, and it's going to be the year where Ethereum will sort of like make a definitive pit stop on what will it be by the end of the year.
Yes, I think most people would agree that layer 2 and Ethereum 2.0 are like the main two, areas for Ethereum this year to follow. There are some sort of checkpoints that you could want to look out for with regards to L2. So I think seeing some obviously successful DeFi protocols transition to L2, I think that's a minimum that we have to see. Synthetics have already started, doing this, are a pioneer in that sense. With optimism and so on. But I think another aspect is to see composability. So for example, several different DeFi protocols interact with each other on layer 2. I think that's going to be a big thing to watch out for. With regards to Ethereum 2.0, I think certainly you'd want to look at the development roadmap. Is it progressing, as we expect with regards to the timeline and so on. But there's also an ecosystem around Ethereum 2. So with regards to staking, for example, and I think many projects were kind of getting ready to, start their staking pools and so on, and then were caught off guard by how fast the Beacon chain actually launched. And so that still has a bit of a drag where, more projects are piling onto the ETH2 staking ecosystem. So I think that's another big ecosystem that's going to grow. Obviously analytic solutions on top of the Beacon chain, Ethereum 2 are going to be popping up. So there's a whole ecosystem around Ethereum 2 as well, beyond just the development of the chain itself.
And I think one question is also like when because the gas problem is what we're facing right now, and projects are looking to move into layer 2. But then when Ethereum 2.0 launches, like what's going to happen between those two things, right? And then you got the Ethereum killers as well, like like Polkadot or Solana, which has some huge backing and trying to get some DeFi projects to migrate over. I think it's a good time to segue to Author. I'm sure yourself looking into a lot of DeFi projects as part of your fund. What do you think about the landscape of all this scalability issue, and also like the Ethereum killer chains, for example, or the alternative chains that try to solve the scalability problem? Like, would there be a migration of dApps to all these different platforms?
Most of the DeFi project, I would say almost, in fact, all that get their start from Ethereum is still going to use Ethereum as their home base. That's not going to change. And I think they are all opportunistically trying out different blockchain or even layer 2 solution just to see which one will catch on. But they are definitely not betting their farm on any of the other blockchain right now, unless like some project like Serum, they start from Solana right from the beginning. That's a different story. Because I think that one thing is there's no user on other blockchain. I mean, like it or not, that's just a fact. And even if there's a user, they do not have the economic activity that can support the kind of a usage you want to see. I mean, to put it in a more blunt way, all the user of other blockchain, they do not have so much capital to support the kind of economic activity you want to see that's happening, especially for DEX, for lending and borrowing. If nobody have, you need some wheels to kickstart the thing, and you also need kind of a lot of intermediate users. So I think, like it or not, the whole DeFi summer and all this thing makes some people a lot of money. But obviously, some people have lost money as well. But I think generally, a lot of people got quite rich in the space. And sometimes you can see a few projects just kickstarted by a group of people that have the money to bootstrap the initial network effect. So, and these people don't really mind paying for gas fee. So I think for other blockchain, it's a bit early to say which one to catch on. I think even for Polkadot, there was a lot of a hype and all this thing, but I think it's still pretty early and remain to be seen. And that's my personal belief. I think that you cannot build a community around pure mercenary. And I think that's what we've seen with a lot of other layer 1 projects. There's a lot of people who come in as a very, very mercenary mindset. Well, for Ethereum, there's quite a lot of people who build without expecting too much in the beginning. I don't think you can do that forever, but initially there were people who did that, and right now it has grown to a very organic and vibrant ecosystem, which is very hard for other ecosystem to match, because you can't really just use money to buy that, because then you just attract all the mercenary guy that come and just take the grant and build, and that's all. So I think that people are trying out layer 2 or like other scalable blockchain, but Ethereum is going to be the home base, and that's not going to change. And I think that, I said, a lot of other older gen layer 1 have under-deliver significantly. I would say they are almost borderline scam for like EOS. I mean, it's a complete joke right now, I would say. So yeah, I think that people are going to be a lot more careful about betting their farm on other layer 1 blockchain, especially if you build a very successful project on Ethereum. Yeah.
Mostly agree with Arthur. I think he was spot on. What I'll say is that yeah, one thing that's worth tracking, the reason why a lot of the L1s right now are getting more attention and more traction is because, like we said before, retail is coming in, and retail is not the most sophisticated, so they buy some of the easy narratives, and scalable fast is easy. It's easy to sell, but to Arthur's point, it's really hard to replicate Ethereum's network effects. It's developers, it's assets on the chain, and then it's also capital. And those three things are really hard to replicate, even if you have a lot of capital, a big war chest that you can basically spend and incentivize users. It's just much harder than people realize. And like Arthur said, you need assets and you need capital for lending platforms to work. You need actual something that's worth lending out, something that's worth actually paying the gas for. So I do think that it's worth paying attention to some of these L1s, but ultimately I think L2 will be where a lot of this goes, and I think L1 will mostly be for settlement and for the larger players to do what they want, and L2 will be for the smaller guys. They want to avoid paying, 20 bucks for one easy swap. And I think a lot of that is changing. Now we saw Optimism soft launch, rollups are starting to get interesting as well. What I think is worth pointing out, and Alex kind of touched on this, is the composability aspect. Obviously, it's much harder to be composable in a lot of these L2s. And it's interesting to see that some projects are choosing Optimism, some are choosing rollups, and it's not exactly clear how they will work together. Or for example, if these projects that start on rollups will eventually migrate into Optimism. So I think that's really worth watching. But I'm convinced that retail people actually using these products, it's fine that they're speculating, but you also need them to actually participate. And that's difficult right now on Ethereum, and I think that's going to change massively this year.
I have one thing to add. I think I think although I'm quite optimistic on the Ethereum ecosystem, I do think that Ethereum asset right now is in an inflection point. Yes, it has reclaimed its all-time high, but I think at this level of market cap, I don't think you can rely on a pure retail buying to push the price up to another level, like what happened to Bitcoin. The role of Ethereum itself, I think if you're like a crypto native or Ethereum community member, you agree that yes, it's the best reserve asset, and within the Ethereum ecosystem, and to pay for gas fee. But how much should it be worth if you do not have sufficient monetary premium? It's not that easy to justify beyond a certain level, because Bitcoin you can always argue it against like a gold market cap. But Ethereum, what are you going to benchmark it against with? It's already the most valuable smart contract asset, right? Yeah, so yeah, I think that's a key part for Ethereum.
I absolutely agree. I think until there's for example, some deflationary effects like burning some of the fees or some other aspect, it's difficult to argue for exactly what the right valuation is. And I think, TM, you mentioned this when you were asking the question, but in 2017, it was quite different because Ethereum was used as the vehicle to onboard to a lot of these ICOs, and the ICOs were so oversubscribed that you had funds basically fighting over to get into a block to get into an ICO and then flip it immediately. So that's not really happening now. Before you had to get Ethereum to get into these ICOs. Now you need some Ethereum to pay for gas to interact with DeFi, but you don't need that much. You don't need to actually get that much money to get into. You can just go on Uniswap and buy in with USDC or some other stablecoin. So it's much different, and I agree that it's very different than Bitcoin, for example, which has a really clear narrative, and again, it's very easy to sell to both institutional and retail people, and Ethereum is not that simple.
Yeah. Right. So just to add on that briefly, I think that narrative point is really important. So if you want to invest in Bitcoin as a narrative, you buy Bitcoin. But if you want to invest in Ethereum as a narrative, you can also invest in certain DeFi tokens, right? And so there's probably some degree of leakage in that sense from the market cap from Ethereum to other tokens. And I think it's natural that you would see that, given how you can invest in these different narratives.
Yeah, and I think to a certain extent that's also starting to happen to some of the DeFi protocols as well. like there's just so many new projects popping up that I think some of them will end up diluting like other projects as well, because you just have so much demand for these projects, and the same is true for Ethereum for sure.
It's quite likely, like in 2017, the mindset was that the layer one will accrue all the value, and then all the apps that are built on top of it will not accrue the value. But in this case, when we look at DeFi, the value is being accrued in all these protocol coins, which makes the landscape very, very different. It could be a sign that we're still in early days, and there will be consolidation eventually, that all the value goes to the clear winner. And I think this makes a very good segue to DeFi, right? So I know this has been a central theme in 2020, although DeFi has been around maybe since 2018, 2019, under the radar, but a lot of the drama, the innovations, the explosion of adoption happened in 2020. So what do you think is the current state of DeFi in 2021? Like, right now, regulatory is not really an issue yet, but it might be. There's also this talk about CDFI, like decentralized finance, where you onboard retail customer in such a way that it's not so scary for them to interact with the DeFi contracts. There's a lot of exploitations that we are still seeing. So I guess like it's really, really general, like what we're gonna expect in 2021. But I'm just curious to hear from you guys. What do you think DeFi will be this year after the crazy run up in 2020? How about we start with Arthur on this?
I think that there's so many things to talk about, but I'll probably focus on a key one. I think from a different sector point of view, I think that we already see like a key leader emerging for certain segment. I think lending and borrowing is one. I mean, I might be wrong, but I just don't see how any new lending and borrowing protocol can compete with Aave and Compound at this stage. The network effect is there, the asset base is there, liquidity is there, and both of them have stand through the test of time, very well audited, battle tested. Why should I trust a new lending and borrowing protocol unless they are giving crazy incentive? But again, that's not going to be sustainable anyway. So I just don't see any new lending and borrowing protocol compete with Aave and Compound in a very. I don't think it's likely. Upmaker is a little bit of a different animal, so I'm not going to talk about that. And I think for spot dexes, I think there's still some glimmer of hope for the newer DEX to compete, but it's not going to be easy because Uniswap have such a huge lead against all the other DEXs. I mean, although I'm like more bullish on other DEXs from a price performance point of view, but you just need to agree that Uniswap is the most successful DEX by far right now. You look at the user, you look at the volume. Uniswap have like I think at least an order of magnitude more users than all the other DEX, even more than the aggregator like 1inch. So like they're the most successful, and I think AMM, despite all the shortcoming, it actually works, and there's such a huge demand for the community to bootstrap liquidity for certain coin and to kind of take like a market neutral view of certain pair like REP, like Bitcoin and Ethereum. People just think that it will always trade within a certain range. I mean, people might disagree, but I think there's a significant part of market that agree that that's a risk that I'm okay with taking it. So I think that it's not that easy to break into the top 5. I think it's possible, but it's not easy. The spot DEX space, I think the Uniswap is going to continue to be a leader. Although I don't know what's up there for V3. I heard it's supposedly going to be pretty awesome. I think SushiSwap is going to continue to do well as well. And all the others are just, I don't see the league table changing much. There might be some new ones that can break into top 10 or top 5, but I don't think the top 3 can be break into that easily. That said, I think that for derivative, that's a little bit unique. I think the race is still on. The leader right now, if you measure by the market cap, is probably Synthetics. But right now, they are not really offering leverage trading yet. So with that, I think the race is still on. DYDX is the one that's been live. MCDEX has been live as well. And there's a few other. I think I can count at least 10 derivative protocols launching this year as well. So I expect this to be the most heated space of DeFi this year. I think a lot of them are going to do liquidity mining. So probably we're going to see another wave of all these people like just attracting the trader and liquidity provider as well. Per protocol has been live as well. So yeah, I think this is the biggest battleground because obviously you look at how successful the centralized exchange has been in capitalizing the derivative volume. And I think insurance can still grow, but I do think that it's unclear how it can become like a huge part of the market right now. Because I think traditionally insurance is always so not bought. So people usually need to get a nudge to buy insurance. So that's something that probably I think the space we need to figure out. And I think that like Multicoin, they make a pretty interesting observation that if you trust the protocol to be very secure, you might not even buy insurance, which is another possibility as well. So yeah, I think that's what other space. I think stablecoin. I think fiat stablecoin is just going to continue to lead and expand their growth. I think the decentralized stablecoin variants, there are some chance they might become bigger, but I think that only DAI have proven itself. All the others are still very in the early days. It's interesting experiment, but I don't think in terms of importance they're going to overtake the fiat-backed stablecoin. And Tether still going to play a very major role in the entire space as well. Yeah, I think that's a journey about the DeFi landscape.
These products that you just named, like lending, AMM, derivative trading, I think they've been enjoying like awesome growth in the past month. Mainly also because there is no, there's no need for KYC or regulatory hurdle where the centralized exchange has to go through. So I guess the key question is 2021 going to be something that these things that the project have to pay attention to? I think Larry may have some insights on this. What do you think, like, with regards to regulation? Will all these DeFi products enjoy not having to worry about this and continue to focus on their product and the growth, or this is something that they have to start worrying about because, you know, as DeFi gets more prominent, it's going to be in the radar of regulators?
For now, there isn't like an immediate threat. That can very quickly change. Like, for example, if the stablecoin regulation goes in place in the US, that will definitely affect some parts of DeFi. But I think for now it's not such a big concern. I think eventually, all of this is running trustlessly. So there's not even much you can do for a lot of these protocols. Like with Uniswap, you can't turn it off. Some of these protocols still have some, you can still do it with admin keys, but most of them are going to be turned off in the next couple of years. And I think regulators are going to be late for most of it. So what I think is quite likely and possible is that a lot of the front ends will end up like, having to block some users, for example, or having to do something else, but then they're going to be like open source front ends and, alternatives. So I think that's not going to be such a big concern. I think one potential small issue is obviously the governance tokens. I mean, for now, there's almost none of them have actual cash flows. Almost none of them actually distribute like some dividends or burns to users. Some of them do, but it's not many. When the governance actually ends up turning it on, I think it is possible that some securities regulators will start paying attention as well. But I think those are the biggest two areas that are worth watching, but I don't think they're going to come anytime soon. I think regulators tend to react really slowly. You saw it with Ripple. It took them like 5 years to actually do something, and that tends to be the case with almost everything. So I'm not anticipating like some action against Uniswap or Aave anytime soon. And when they do, I think it's going to be too late. So that's my view on that. And when it comes to different areas of DeFi to pay attention, like Arthur said, I again agreed with most of it. Totally agree that derivatives are going to be something to watch this year, and that's mainly because previously it was quite difficult to actually make derivatives work on chain, but now that we have some L2s and different solutions come online, and also BitMEX being taken down, and I think that now is a really good time to start paying attention to a lot of those, and there's not a clear winner yet. If you look at something like synthetics, yeah, they have by far the highest market cap, but they have very little user activity. And it's still mostly used for front running. So there's a really big bounty for someone who figures that out and who actually ends up getting users without incentivizing them directly. So yeah, I think that's mostly my thoughts.
So moving on to Alex, like I'm not sure whether you start to notice how the retail participation is like. So I think for a while, using MetaMask, using DeFi product has always been a advanced use case. And then with the advent of Uniswap, people start to learn how to use MetaMask, learn how to swap tokens. Looking at the on-chain activity, like do you see even up to today a continual surge of retail users using DeFi products directly, or do you think that that's not growing as fast as you think it should, and they may most likely will be using the CDFI, like going it through centralized exchange to stake their tokens and things like that?
Well, I think there's two ways to look at this. One is from just the perspective of the user. Most of us are already users in this space, and we've gone through these user journeys ourselves. And it's pretty clear that the process of getting active in say, using Ethereum and so on has been much more convoluted in 2020 than it was in 2017. In 2017, as a retail investor, as Larry said earlier, you bought some ETH and then you flipped it on some ICO, and that was it. Now, the yield farming, schemes and all that stuff is a lot more convoluted. So certainly, I would say that to some extent just makes it more difficult for retail users to participate. So that's on the user journey side. And then if you look at the data itself, it's a little hard to distinguish, what's retail users, what's institutionals. But if you can, of course, look at volumes and like how big the transactions are and so on. And it's a pretty clear trend in 2020 that, stablecoin transactions have tended to become larger, simply because of fees, I would imagine. It's more congested. And so the economics no longer make sense for you to send like $10 on chain. And so that basically drives the larger transactions to take up more bandwidth, on the network. And that's pretty clear from the top of my head. I think we might have gone from something like 30% of all transactions, being less than $100 down to say 10 to 15% over the course of 2020. That's been definitely a very clear trend, that they're being squeezed out and marginalized to some extent just because the economics no longer make any sense. So I think it's important as well to keep in mind, why are we trying to, replace the financial foundation and so on, and have an inclusive financial system. So it is a bit worrying that it becomes, increasingly convoluted and difficult to deal with blockchains. I don't think L2 will necessarily make that easier. It might just be even more convoluted, right? It's just like another hoop to jump through. The optimistic take is maybe that some of the fintech players that traditionally have not been very present in crypto or DeFi, say Revolut, PayPal, who knows, Robinhood and so on, start experimenting a bit more with DeFi backends. And so, I don't really see a future where 1 billion people are using MetaMask, but you can see 1 billion people using, Revolut, Robinhood, etc. So that might piss off, some of the purists in the crypto space, that not everyone's like doing everything self-custodial and so on. But I think that's basically the only way forward if you want to have, really massive retail adoption.
Yeah, I will just add something to that. I totally agree. I think retail participants are not really interested in like just flipping Uniswap tokens. Yeah, like some people are opportunistic and they'll do it, but it's not that interesting. Similar to lending. I mean, it's over collateralized loans. It's not that interesting to regular people. What is interesting is some of the savings products, for example. If you if like all the institutions are using these products and that ends up generating yield, I can clearly see some like fintech applications actually plug into that and then start offering users a little bit riskier but higher yield.
Yeah.
So that I think is another area where it makes sense, and then potentially derivatives of like real life assets. I think that's also interesting, but it's just much more complicated when it comes to either like bringing some of these on chain or then creating synthetic assets that represent those claims in the real world. So I think that there's still some time for that, but I think savings vehicles for retail users could bring on like hundreds of thousands of users.
Yeah, I totally agree. I've spoken to a lot of entrepreneurs that are keen on bringing out these ideas because they're actually not very complicated to implement, right? Yeah. But it's like regulatory hurdles. Can you call it savings, right? Depending on your jurisdiction. There's also basically the hedging component. So if you want to offer savings rates on local currencies like euros or Singapore dollars or anything else, you need to hedge it, and there's a custody aspect to that, et cetera, et cetera. But these are, from a technology perspective, not very complicated things, right? It's more of a regulatory hurdle at the moment. So if we see a bit of progress there, I totally agree with Larry. That's probably the first mainstream application of DeFi would be a savings product that is easy to use from your mobile.
I think this goes back to Arthur's point as well with regards to insurance, right? So I think when all these institutions start to adopt DeFi, it's easy to plug in, but how do you manage the risk? Is there any existing insurance company that is willing to insure this product? And that's where a very crypto native sort of insurance product may sort of like fill that gap if there's any sort of institution that wants to integrate this. So that could be a potential possibility for that ending. I don't know, just a thought. We're going to talk a little bit about M&A, IPO and SPACs. So I think there's a brewing excitement around Coinbase upcoming IPO. We're starting to also see a lot of specs that is specific for crypto starting to pop up and capitalize on the excitement. So I guess just a very general thing again, like given the nature of the volatile crypto market, Bitcoin goes up 40K down to 35K, 30K. And I think if this companies that are dealing with Bitcoin gets traded publicly, I'm sure they will also inherit the same volatility as Bitcoin. So I guess the question is now that are we ready for a sustainable market that trades publicly traded crypto company? Because it's going to be super volatile, even more volatile than a tech stocks, I imagine. So yeah.
I totally agree with you. I think a massive theme of this year will be crypto companies going public, and that includes, exchanges like Coinbase will go public. Gemini will likely do some deal. Kraken and Bitstamp are considering. BlockFi likely going public. There's just so many companies that are lining up right now, and it's because Coinbase is obviously going to start a massive wave of just interest. So I wouldn't be surprised at all if Coinbase trades at more than 100 billion this year, and I think that's just going to start a really big wave of companies just considering it. I don't think it's going to be as volatile as like something like Bitcoin or other cryptocurrencies. I mean, we already have some stocks that are already trading publicly, right? They're not massive, but we have like something like Silvergate, which is quite reliant on cryptocurrencies. We have MicroStrategy basically running an ETF, and then there, Galaxy. They're quite volatile, but not as much. I think the market will be fine with it, and you can literally see that in the US right now. There's hundreds of thousands, or at least tens, probably hundreds, downloading Robinhood and just gambling on options. So I don't think retail people are that concerned about volatility per se. I think it's just going to make it more interesting for them to participate. And it's also, the swings are going to be wilder. The returns are potentially going to be better for them. So I'm not that concerned about it. What I'm a little bit concerned about is like so many of the companies going public that it can like dilute some of the capital. Coinbase obviously is one, but then if it really does explode this year, a lot of new capital will have to come in for this to not to dilute.
Got it. How about Arthur? Do you have anything to add for this case?
I think we are just going to see more of them getting listed, be it Coinbase or even BlockFi as well. I think this is the perfect market, right? I joke about like it's all a capital market game right now, due to the unprecedented monetary easing by central banks around the world. People just want to allocate their money to the risk asset because where else can you put your money on, right? So as a result, it's probably the best time to get the favorable valuation together with the bull market in Bitcoin this year as well. And in fact, we have seen quite a number of backdoor listing. I would say that there are some companies that if they did not manage to tap the capital market funding, they will have never survived because they just never make money. I don't want to name names, but people.
Oh, come on. Let's just name that. Come on.
Yeah. So there are some firms that I just don't understand how can they have such a high level of burn. It just doesn't make sense at all. But yet, because they can tap capital market funding, they can just do well, and they might even go up now because the crypto bull market, and the funds will buy them as a proxy to crypto without touching crypto directly. So yeah, it's the best time to list, best time to play the capital market game. Get the valuation and the multiples pump up. I think that it's a great opportunity for all the crypto companies to get the exit they are finally looking for. Yeah.
Maybe the Block and Nansen should go public this year.
Go ahead. Yeah, you guys might trade at a few hundred million valuation. Yeah.
Right. And so, okay, so yes, definitely, I think something to watch for. Specs, the public market. I mean, that's only in the US, right? What about other parts of the world, right? There could be such creativity in terms of taking advantage of the capital market. So I guess again, switch to another topic. Trying to go as quickly as possible. I think this one is a bit of a niche, something that hasn't popped up for a while. It's about privacy. So I think a few years ago, privacy-centric cryptocurrencies like Zcash, Monero, Zcoin were really, really popular. It has its run, but then I think in recent times, no one talk about it. It seems like nobody really cares about privacy at all. Like, in fact, people are using Ethereum a lot. People are using Bitcoin a lot when all this blockchain has no built-in anonymity features. I mean, you argue that Ethereum has some other smart contract that can interact to use some privacy feature, but do you think privacy will become important again in 2021? Looking at the fact that no one has been talking about it for the past few years, maybe it will pop up again this year. So Alex, do you have anything to talk about this with regards to privacy on the blockchain?
Yeah. So obviously for me, it's natural to think about privacy in the context of Nansen, because we do a lot of wallet labeling, right? So we associate corporate entities, project entities, mining pools, and so on with addresses. It is important for me to point out, though, that we do not label individuals unless they are already in the public domain. But we have, of course, been confronted with this a few times, this question, and it's something we have discussed a lot internally. The benefit of a product like Nansen, for example, one of the benefits is that people actually become a bit more privacy aware. So if you go back 1 year, I imagine some people now are thinking more about their own privacy, their own OPSEC and so on than they did before. Of course, we're not going to take all the credit for that, but I think it's becoming something that people are increasingly aware of. So if you look at the data on other blockchains where you have more privacy features, it's not very clear that this is something that the market is screaming for. And so maybe some of the other guys have more hard data on this for the other chains, but if you look at Zcash or Monero and so on, they haven't really had that much adoption when it comes to the privacy features they have. You could also think about blockchain from the flip side of privacy, which is transparency. And so it's an opportunity for many projects, funds, and so on to be more transparent with their holdings. And maybe this is to be seen as a feature, not a bug of Ethereum, right? So I think you have to think about this along two dimensions. One is what's sort of privacy, and on the flip side, what could be considered transparency in a positive way. And then there's, of course, the massive distinction between individuals and corporations or projects and so on. And so I think with Ethereum, there's some interesting anecdotal evidence that some traders are actually interested in being transparent, but perhaps not revealing their own identity. So they can have like an on-chain influencer persona, on the blockchain without people knowing who they are. And, that's actually something that you can compare to social media, right? I'm sure when social media came around, many people thought this is incredibly privacy invasive. But now, today, many aspects of social media are totally accepted. So I think this is a very rich and interesting area to discuss. But you have to keep in mind, what things are, privacy, what's the flip side, transparency, and then the different elements of, wanting to share versus being doxxed and so on and so forth.
I totally agree with that. But to be even a little bit more blunt, I think Ethereum is kind of struggling with this right now, where like some funds would definitely not want us to know when they're shorting something or when they're lending something. And I think it is going to change in the future. But one thing to say, I think at this point, a lot of the Ethereum users are really don't care directly that much about privacy, just by seeing how easy it is to actually dox some people. Like some people, they buy an NFT and post it online, and they don't realize they leached their main wallet through 2 hops. Like that kind of stuff happens all the time. It's incredibly easy to dox people on Twitter, and I think that will need to change. I think Ethereum will change that directly, though. I don't think this activity will have to migrate to like fully private chains. I think it'll have to happen, on the main chain.
I think that privacy is something that all of us wish we have, but unfortunately, that it's just very hard to reconcile with the other aspect of permissionless blockchain, because if you're not transparent, you kind of lose one of the key attributes of blockchain as well. How do people verify that there's no like a hidden inflation bug, right? I think that's a huge issue as well. Probably there's another 50% more minted that nobody even know, because it's all privacy and hidden. And also, like, it's even unlikely for a regulator to allow them to have a fiat channel. And I think more and more exchanges is going to get pressure for them as well. So I think that it just make it a lot harder for the entire ecosystem to use and support a privacy coin. I think that's just, and usually they have a very terrible token economics as well. I mean, like Green and Beam, they have such an insane inflation rate that everyone just gets so poor from holding them. I think that's a part of the reason. So I mean, same for Zcash. I mean, everyone that bought the beginning is so fucking poor right now.
Cool. Yeah. One thing I was going to add to agree with Arthur is that exchanges will absolutely be pressured to delist those coins that are fully private. I mean, it's coming. It's basically part of the DeFi regulations. It's only a question of time when that happens. It could be 2 years, could be 10 years, but it's just, to me, it's hard to kind of convince someone to invest in those when you have this eventually this threat of being delisted. And then now you see with something like XRP what it's doing to it, right? Like when you drop all the liquidity and you literally have to go back to trading this on the street like local Bitcoins, a lot of users will just leave because privacy is something that you don't actually need that often specifically. Yeah, like at some point you'll definitely need it. But I think this is the biggest issue. Like exchanges will not be allowed to list it eternally. I think Zcash might be, some sort of a loophole where you have like two, one is private, one is not. But I think even that will face some issues in the future, and that to me at least makes it really difficult to invest.
Yeah, that definitely puts crypto use in a tough spot. Right? I mean, either one has its own like pros and cons, and I mean, it'll be interesting to see. I think as long as people are aware with how about privacy issue, I think we're moving on to the right direction. Right. So if you look at the cryptocurrency history, 2020 last year was DeFi, right? I think DeFi was a catalyst and almost predominantly dominates the whole year. 2019 was derivative. 2018 was security tokens, STO. 2017 was ICO. 2016 was enterprise blockchain. What do you think 2021 will be? Like, we discussed a lot about the themes. There could be something else that we didn't discuss that you think will set the tone for 2021.
I think I have some reservation about the usage of this term, but I think the key theme will be institutional adoption. That should be the key theme of this year, because I think that people sometimes amidst the daily market fluctuation of crypto have actually ignored that how much improvement in the infrastructure has been made over the last 2 years. And actually there was a lot of people that were deep on building on it and like preaching the benefit of crypto and blockchain to the wider group. And a lot of things just don't happen immediately, right? But gradually more people just started to believe in it, do their research, and slowly just adopt with it. And I think that this year is finally the year that we are gonna see an acceleration in the adoption from an asset allocation point of view, from like a more mainstream integration point of view. I think it's possible that some like a fintech company like one of us mentioned that will integrate some DeFi feature into it and offer it to their users. Or it can be possible that some of the DeFi protocol, they might have a regulated entity that offer these services that integrate with their DeFi protocol as well. I mean, Aave has an electronic money license in UK, and I'm sure they have some plan for it as well. I'm not sure what's the plan, but I think it's very likely that they can offer like a fintech platform that plug in directly to their Aave protocol, and that can actually kickstart the mainstream adoption. And I think that there will be definitely a lot more of the like a family office, some bigger funds start to allocate into Bitcoin. And I think some of the more adventurous one might even journey beyond that and to invest in Ethereum or even DeFi as well. I think that the institutional adoption is just gonna further accelerate this year.
I agree with that. I think that's on point. I think other themes to watch will be the derivatives that we talked about, the growth of on-chain derivatives. Then I think another area worth to watch is the stablecoins and the stablecoin growth that we'll see this year. Like right now, there's like probably 90+% of all the stablecoins is used for trading, collateral. It's basically only crypto use cases. I think that's going to change this year. I really like the direction that USDC is taking. GMO just launched a stablecoin as well. I think it's going to be used more for FX, more as a settlement layer, and then also I think they will integrate in some banks and just use them for deposits as well. So I think that's something to watch as well. One thing I want to close on, just kind of optimistic thought. When I started doing this full time in 2017, I was really discouraged all the time about the people in the space, and overall, I didn't feel like a lot of them were like, had good intentions, were acting in good faith, were smart. I think that has changed significantly. I think now that we look at, the people that interact with these protocols, the people that invest in Bitcoin, I think they are much smarter. They have much better reasons to interact with these protocols. And even like when we're hiring for candidates, we're getting like Stanford PhDs, Harvard PhDs to apply for research positions at the block. It's ridiculous. So much talent is going to be coming in this year and next year. So that's something I'm super positive about, because these people are really bright and they're going to make it work. I mean, this technology will end up working. And the only question is how.
Yeah, I think it goes back to where we started really on how this bull run is different. So I think it comes back to the two factors, as Arthur said as well, institutionals effectively being mostly interested in Bitcoin. But I think there's also a broader meaning of the word, institutions. I think it has to do with also companies just using crypto. So like stable coins, making use of certain DeFi protocols, either directly or indirectly. So I think the keyword institutions definitely, I think, will be a big theme for 2021. And I do think that the other theme will be about scaling Ethereum, because that's where really most of the developer activity is. It's where most of the organic user activity is. And so, L2 and Ethereum 2, as we've already discussed, those two topics and, under the broader umbrella of scaling Ethereum are going to be extremely important this year.
Thank you everyone for joining us for this meetup on the state of crypto market 2021. I hope all of you learned something. I definitely learned a lot from today. I mean, the spaces to watch, the sector to watch out for. Special thank you to all of our speakers here who took the time to share their thoughts and insights with everyone. So with that, I hope everyone take care and have a good one. All right.